Okay, folks, so we're finally getting things moving along so far as the newsletter is concerned. Again, this is the second presentation for the year, so we'll keep moving along. Anyway, what's going on right now is something that all of us are concerned with, and it's at the top of the every headline has to do with the Strait of Hormuz and the issues with the conflict, war, etc., with Iran. Anyway, so thought that given that this would be a good time to kind of revisit uh, what's happened over the course of the last 50 years or so, going back to 1973. So I guess that'll be 53 years ago. Anyway, uh, and again, all roads lead to the Middle East so far as these issues are concerned. So anyway, so let's get started on this. So again, the focus is the Strait of Hormuz, and hopefully this is something that will be resolved in the near future. But at any rate, the current situation, if you will. So anyway, the point is that the Strait of Hormuz, it connects the Persian Gulf with the Arabian Sea, and that choke point that is the Strait of Hormuz is very narrow. It's just a few miles across at its narrowest point. It's between Iran and Oman on that peninsula that juts out going north. And that, of course, is something that's been uh, uh, the the mainstay, if you will, of Iran controlling the flow of oil over the course of the last 47 years, I guess, going back to 1979 with the revolution in Iran. Anyhow, so again, this is a strategic choke point, and the volume is about 20 million barrels a day. And bear in mind, 20 to 21 million barrels a day. That's about 20% of our global petroleum liquid needs that are, if you will, that are consumed on a daily basis. So we're consuming in the world about 100 million barrels of crude oil a day. In its various forms after it's been refined and so on and so forth. It's a huge number. And again, this Strait of Hormuz is a major choke point, and all the Gulf states that uh, are in the area, including Iran, Iraq, Kuwait, Bahrain, of course, Saudi Arabia, Qatar, Qatar, UAE, Oman, I mentioned as well before. This is a major choke point, and it's always something of a concern, if you will. So what's happened is that going back to, I guess this would be April now, just a couple months ago, a few months ago, was when this issue was initiated. Again, this is where the geopolitical intersects, if you will, with the economics. And so that 20 million barrels a day was pretty much cut off overnight, and as a result of which there was massive efforts to remedy the situation. So to provide a little bit of context to this situation, the Strait of Hormuz, it's again that 20.9 million barrels per day that are passing through the Strait of Hormuz. The only one that's larger would be the Strait of Malacca rather. Strait of Malacca, which again is going through Indonesia and that area, and that would be traffic oil super tankers, if you will, going through to China and to Japan primarily, but also, of course, the entire Southeast Asia and Asian concerns. There are others, of course, but again, they pale by comparison when you're looking at the Strait of Hormuz and the Strait of Malacca, rather. So this is interesting. What we're looking at on the left-hand side is the origin, if you will, of where this oil is coming from. And the largest player, of course, would be Saudi Arabia, then Iraq, UAE, Iran, Kuwait, and Qatar. Um, and on the right-hand side would be the destination for that oil. And primarily, it's going to China, India, South Korea, Japan. So this is mostly going to Asia, most of that oil that's passing through the Strait of Hormuz is heading west again through the Strait of Malacca. So a smaller portion is heading toward Europe and the U.S. And it's also Saudi Arabia that's thrown here too. But uh, what a thing to keep in mind is that we're looking at the overall worldwide consumption of oil, that crude oil being at about 100 million barrels a day. So when you take out this portion, that's 21 million barrels of oil from the Strait of Hormuz, it disrupts the entire world economy, driving up, of course, reducing the supply, driving up the price of oil. The other thing of note is interesting, don't really talk about it at all, other than right now, is that there's also a huge amount of not just oil, petroleum flowing through, but also natural gas flowing through the Strait of Hormuz. In this case, we're looking at 11.4 billion cubic feet per day. Again, very, very large amount. So it's not only oil that's being disrupted, price of oil going up, but also that natural gas that was cut off as well. We'll be getting into greater detail later on, but it's pretty straightforward. When you cut off that large of a portion of oil, again on the right-hand side, it shows the whole world, the world total oil supply about 104 million barrels per day. And a good portion of that, 80 million barrels, are transported via supertanker or tankers of whatever variety. But again, that 21 million barrels a day through the Strait of Hormuz had a significant impact. And immediately what happened was, as has happened in the past, we'll be talking about it, is that prices skyrocket. And the consumer doesn't have much choice, at least in the near term. That's the whole point behind this elasticity that bringing into play is that we're suddenly stuck, right? So there's this short-term demand inelasticity that pops up. And there's, as a result of which, of course, people respond to that. People respond to that in terms of the suppliers respond to this, trying to anticipate how long this issue is going to persist, and so on and so forth. And of course, markets react by prices going up or going down. And in this case, with that massive restriction in supply, the prices would go up significantly. So again, we're seeing this massive volatility even today. Right at this moment in time, we see prices fluctuating $1 or two per barrel on a pretty much on an hourly basis, it seems. Again, because of this disruption of what's going on in the Strait of Hormuz. So going back in time to well, I'm sure there have been other crises before this, but the 1973 oil crisis is the one that people always, start with when we talk about the oil crises, if you will, emanating from the Middle East, right? So that was in 1973, and this was the OPEC response to the U.S. involving themselves with Israel during the Yom Kippur War. And meaning that the U.S. had sided with Israel and the Arab states, the Arab members in particular, Saudi Arabia, of course, being the major player in OPEC, right? They're the ones that drive those prices. They're the price leader, if you will. Uh, they had it was again a response to the U.S. Supporting Israel during the Yom Kippur War, and prices quadrupled overnight, going from $3 a barrel to $12 per barrel. And that very quickly translates into there's a uh, what happens is that when oil prices rise very quickly, the response at the pump, so far as gasoline, diesel, etc., those prices are almost immediate, so far as that's concerned. And what we've noticed, of course, is that uh, when you have a relaxation of this, where prices of oil perhaps come down, there tends to be a lag so far as the the prices at the pump and gasoline, diesel, fuel, etc. At any rate, so prices quadrupled pretty much overnight, and that was absolutely devastating at the time. There were massive, again, as a result of this, there were massive shortages with gasoline, where people were waiting in line for just to get 10 gallons of gasoline. But bear in mind again, we had we did not have energy-minded vehicles at the time in the U.S. I'm talking in particular. Um, so having a vehicle that was getting 10 miles per gallon was pretty much standard. Um, and that doesn't go over very well when you're seeing the price of your gasoline at the pump prices rising so darn rapidly. At any rate, so the response, of course, from the government was it was twofold. I guess there's more than this, but just a couple of examples that reducing the overall speed limit to 55 miles per hour, and that went on for a long time. So I think that was implemented in around 1974, I want to say, and it was removed uh, in the 1990s, probably the mid 1990s, and that was also when the SPR, or the Strategic Petroleum Reserve, was put into place, and the Department of Energy was formed. Again, because this was such a critical area that was fundamental to, to us as an economy. So the next trigger would have been interesting. Here we go again, right? With the Iranian Revolution in 78, 79. And so as a result of that disruption, again, the oil pretty much stopped flowing out of Iran, and it caused major significant problems throughout the Gulf. And because of all of the disruptions with the Iranian Revolution at that point in time. So there was not an embargo as was called in 1973. This was a disruption caused by political instability in Iran. Again, that was in 1978, 1979. So once again, to put this into context, if we're looking at prices from 1970 out through to 1985, what you'll notice is, again, from 1973, we're again adjusting for inflation using $2025, 2024, 2025 dollars, if you will. So we're adjusting for that inflation. Uh, so we had the equivalent of going from, again, 1970, we were at under $30 a barrel, and with the increase in um, with the embargo in 1973, it popped well over $40 a barrel, and it stayed pretty steady at that level, kind of going forward, over $40 a barrel. Uh, OPEC liked it. They liked the idea of being able to restrict supply, and by restricting supply, they were able to exercise their price power, and with more revenue. And then in 78, 79, we see that tremendous spike going from maybe $45 a barrel up to roughly $120 a barrel by 1980. This massive increase in prices, and what you'll notice is that the prices did come down. They started coming down pretty rapidly again, so far as inflation, because there was a lot of inflation going on. This was a very, very high inflation time. This is where not that most of you guys won't be around, it wouldn't have been around this time, but we saw this massive inflation. We had really, what was going on was stagflation, where we had inflation coupled with the economy going into the tank as well. Anyhow, what you'll notice on the right-hand side, this shows the gasoline prices. So gasoline prices going back to like 1970 would be at about $3 a barrel. So remember, our $3 a barrel today, excuse me, a gallon, our $3 a gallon today, that's what it would have been in 1970. So in current dollars, if you will. All right. So we saw that again. That's the jump, this uptick in gasoline prices, up to about $4 a gallon post embargo 1973. Again, because OPEC liked this increased revenue. Sounds good, right? When you can control the markets like that, you can control prices, controlling that supply. And then going from 78 to 7 to 80, we had the equivalent of more than $5 per gallon gasoline. And after that, it started to come back down again, back to the 1985 where we were at about that $3 level, if you will. So this is interesting to kind of put things into context that yes, we've had prices, even though the prices were significantly lower, when you adjust for that inflation, that $3 price is kind of, it seems to be somewhat the norm out there so far as gasoline is concerned. That $3, that our current $3 rate. Not that we're paying $3 a gallon, but as a that's pretty much the norm as it is right now, if you will. So what's interesting about this runs the entire time frame, if you will, from 1970 through 2025, we'll say. Um, and again, we're adjusting for inflation over this period of time, where we saw the spike, if you will, going with oil zooming up, if you will, by 1980, and then it came down, and it continued to go downward, the price of oil, until it hit a rock bottom number in the late 1990s. So this was the time. What happened at this time was that we had transitioned from gas guzzlers, if you will, to more econo boxes, driven by a lot of Japanese imports to start with, along with the German imports, and others that were much more fuel efficient vehicles. And finally, the U.S. Automakers also stepped in and produced much more fuel efficient vehicles. And then we had government, pushing things like the CAFE standards, where they were forcing auto companies to raise their miles per gallon, if you will, on their fleets, and so on and so forth. So that massive import, the number of imports that were coming in, changed things significantly so far as like the auto industry is concerned. And as a result of which, what happens is that this was something, it's called demand destruction. And what happened was that because of all of these efforts that were put into place where you're going from probably 10 to 15 miles per gallon average, doubling that. So the demand for the gasoline, if you will, is going to come down. Much more efficient vehicles, and as a result of which, the demand for vehicles for the fuel, oil, gasoline in this case, comes down, and the prices are going to come down as well. So what happened was that in the 1990s, in particular, this was when the the petroleum industry found itself to be very, very challenged, and this is when they started pushing very, very hard for consolidation, and we'll be getting into that shortly. So again, as I mentioned before, in the 1990s, we saw a tremendous fall off in the demand for oil and petroleum products and gasoline, diesel, et cetera, for the reasons I had mentioned before, and that we saw a massive increase in the fuel efficiency of vehicles, and there was also an oil glut because there was what happens when you have uh, organizations like an OPEC. Um, it's a natural offshoot of these types of cartels is that you end up cheating, meaning the different members start to cheat, and as a result of which, if you can garner a higher price for your fuel, so you want to pump out more fuel, more oil, right? And as a result of which, when everyone starts cheating, the supply goes up, and if the supply goes up, the price is going to come down. Anyhow, a lot of things kind of going back and forth, but you kind of get the idea. So this is on the world level when you're talking about with OPEC. So we also have, of course, major oil producers in the U.S. And so what happened was that these oil producers like the Exxons and the Mobils of the world were finding it very, very difficult to remain profitable. And as a result of which the way that you can kind of remedy the situation, of course, would be to do what? To consolidate, to merge, to acquire another firm. Um, and they made a good case, because the profits had fallen so much. They were talking about, you know, going bankrupt and, so on and so forth. But anyway, the net result of this in the 1990s and going into the early 2000s was that there were massive numbers of mergers. So this is where we see Exxon and Mobil coming together. Combined, they ended up with about 13% of the market. And in this case, you're looking at it in terms of refinery, but they would have also been in the production of crude oil at the well, um, at the again refineries, and also at the gas station, at the gas pumps, right? So we also had BP, Amoco, and Arco merge, so that they went from lower single digits to, again, 12.7% in 2001. And you also had Chevron and Texaco merge combined, right? Conoco and Phillips came together. Marathon and Ashland, they were a bit earlier in 1997. But again, you're looking at massive consolidation, massive numbers of mergers, and not to be uh, not, not to be excluded from this, of course, would be Shell. Shell picked up Pennzoil, Quaker State Oil, and they became a massive player so far as the lubrication um, market, if you will, is concerned. And they are also, of course, buying up. They were also been involved in crude oil production and so on and so forth. That's something to kind of keep in mind, of course, is that when we're talking about these domestic producers, remember, Shell is what? It's it's Royal Dutch. I think it's Royal Dutch Shell, right? So it's a Dutch company, and also, of course, when we talk about BP, that's British Petroleum. So make no mistake about it, these are while they are domestic producers, there's also an international component that is involved with this as well. At any rate, so with this mergers and consolidation, so on and so forth, by doing that, uh, the reality is that you're really talking about what? Controlling supply. Being able to do what? To have market power, to be able to have price power in the process. So this was the result of what was going on post mergers, if you will, going into the 2000s. And also keep in mind that in the 2000s, and this is where we'll be walking through this shortly, we had massive increases so far as economic powers in terms of China, India, of course, uh, coming up at that time too. I do like this graphical representation of this, the great consolidation, if you will, that we'll talk about in the 1990s. Again, bear in mind that there is some rationale behind this, and the rationale behind this, of course, was that we saw a oil glut, we saw collapse in oil prices, and the domestic producers were definitely under siege. No, and they're having tremendous amount of profit compression. How about that? They were not very profitable at all, if at all profitable. So there was definitely a desire to merge. This helped to encourage this, and even always keep in mind that these are things that have to clear when we're talking about mergers and acquisitions. It has to go through the Federal Trade Commission. So these all had to clear going through massive antitrust with the Department of Justice. A lot of hurdles that would be involved. So there are a lot of machinations, if you will, that are going on at the same time. Anyway, again, this is kind of a cool thing where we're talking about ExxonMobil merging to become ExxonMobil. BP, Amoco, Arco, Castrol thrown there as well. all kind of consolidating, if you will, merging, being acquired by BP or British Petroleum. Chevron, Texaco, Conoco, Phillips, Phillips 66, merging to become ConocoPhillips, and of course Shell picking up lots of things along the way, including Texaco and Pennzoil and Quaker State, and then Total, which is a French company, I believe, um, bringing things together again with going through Valero and ultimately again when we're talking about Marathon and Ashland, bringing things together on the bottom. So massive compression so far as like the numbers of players. And so that of course means that when we're talking about this consolidation, mergers, coming together, so far as the acquisitions are concerned, we're looking at a significant increase in the amount of market power that results from that. And it's still, of course, in place today. So again, bear in mind, we're only talking about oil. We're only looking at, the fossil fuel oil and its derivatives, gasoline, diesel, kerosene, jet fuel, asphalt, the different components, the things that are derived from that petroleum. So we're kind of foregoing talking about another major portion of that, which would be natural gas. But we'll get into that at some point as well. But again, trying to stay focused on oil, we're looking at oil. So the actual production of oil is that crude oil production, meaning what's being pulled out of the ground. So whether we're talking about, at a wellhead in West Texas, or we're looking at something from the Dakotas with the Bakken shale, so on and so forth. That's what we call the production of crude oil. So it goes from the wellhead, if you will, to the through pipelines typically. Could also, of course, be shipped by rail. It could even be shipped by truck, but that's neither here nor there. Point again is that it has to go from the wellhead to the refinery. So wellhead, refinery, and from the refinery to the gas stations, right? So the point is that when we're talking about refining capacity, this was also lots of consolidation that was going on then. So for example, we're looking at most all of the refining capacity is nearly half of it is in Texas and Louisiana. Um, Anyhow, that concentration is amazing. So if we're looking at the top 5 refiners combined in 1993, they had about a 36% market share. By 2002, they had well over 50% market share. So if we push that up to the top 10 refiners, that they had over a 50% market share in 1993 at 55.6, and in 2002 that got pushed up to 78.3%. So the takeaway from this is that we're looking at what? We're looking at more market concentration. When you have market concentration, there's more market power that is manifested in that. At any rate, it's also interesting to note where these refineries are at. For example, like in Michigan, we have one medium-sized refinery at there. Again, there's just one in Michigan refinery. That's the Marathon refinery in Detroit, or anyways, in the Detroit area. And so these refineries, again, most are based where? In Texas and in Louisiana, or a good portion. So how do we get the refined product from Texas or Louisiana? It can go one of two ways. It can either be shipped by ship, or it could be transported via pipeline. I guess it could go also by train. But much of this is going via pipeline. So we're looking at finished product, if you will, that's flowing through these pipelines. It's not just crude oil. So keeping that in mind, right? So once again, now we're looking at time-wise, we're back on our chronological look at this, is that we had prices dropped precipitously in the 1990s. And then what happened? The demand took off. It started taking off. Why is that? Because of China in particular. But it would not have just been China. It would also been like India and Asia in general, becoming major, major manufacturers. And as a result of which, there's a need for what? Energy. Again, pretty straightforward. So again, as a result of which, what happened to prices? If you look at our handy dandy chart on the left, this is our crude oil, went up significantly. In fact, went up to $120 a barrel, a little over that. That's the lead up to what? The financial collapse in 2008. Again, remember, I think the highest price that we've had for crude oil was a buck 45 a gallon. I mean, I'm sorry, $145 per barrel. Excuse me. $145 per barrel. It peaked. I forget it would have been in the 2000s, earlier 2000s, or again, good lead up to 2008. So we had these massive price increases, and it peaked out again, and you saw the collapse or the coming back down again after 2008, and that would have been again the financial collapse in 2008, the recession, the Great Recession, if you will. But there was something else that was going on, and that something else was fracking. So we had the fracking revolution that started about 2008. It may have been a little bit earlier than that. But the thing to keep in mind about fracking, and it's something important to note, is that it's been around a very, very long time. So this is when we're speaking to elasticity. This is where that price elasticity of demand comes into play, is important, is that time component. Where there was no other alternative before, along comes fracking, and that opens up another door toward what? Toward increasing supply. Increasing supply, just shifting supply in and of itself will do what? Will reduce prices, all else equal. Keep this in mind. So this shale revolution, if you will, fracking, a lot of people don't like the idea of fracking, but it's served its purpose in terms of what? Increasing supply, and it really broken the stranglehold that OPEC had on crude oil in particular, but also in terms of what? Natural gas, which again, we're not really talking about focusing on on petroleum or oil, gasoline, et cetera, right? So as a result of this increased supply, we see prices coming down in a real sense. And if you look at the right, the gasoline prices through 2025, it would have been about $3 per gallon, which was about the same in real terms as it was in 1970. So this is an important point to note, is that this increase, again, the shale revolution, has really made a huge difference in terms of bringing some price stability, reducing prices overall. For whom? The consumer. So when we're looking at the impact of this shale revolution, again, going back to, I guess, 2005, they've got this on the chart here on the left. See this massive expansion so far as the fracked oil is concerned. So fracking is coming from where? It's horizontal well drilling. Anyway, it's the process is pretty straightforward. You drill down and then you horizontally go through whatever that the shale formation is, and you break it up, chemicals and so on and so forth, and you draw out the oil from that. And so we're looking at a lot of it, of course, in Texas, West Texas, the the uh, the the shale that's coming from I forget the name, um, Ford shale, and we'll just say Ford, and also Bakken coming from Dakotas, North South Dakota. I believe I forget which one it is. Anyhow, lots also coming from like Colorado, and a lot of west coming from various places. And Eagle Ford is the one I was thinking about in Texas. So we're looking at, so far as like the normal, if you will, traditional drilling has been pretty straightforward. It's been about 5 million barrels per day, looks like, roughly speaking. That's stayed pretty steady. But shale has gone through the roof so far as the production of shale is concerned. It's over 8 million barrels per day in 2025. And I don't think there's any let up in sight, and may or may not be. But the point is that it's made a huge impact. And remember, so the U.S. Um, we're still importing a lot of oil. Don't get me wrong. But what you'll notice is that we are also producing much more oil. So we've become the largest producer in the world so far as oil is concerned. But what's interesting about the graph on the right-hand side, we're looking at, consumption has gone up so far as our consuming petroleum products, whatever those might be, again, gasoline, diesel, etc. Um, but we've also done what? We've increased our production, and our production is actually beyond what we're actually consuming. So this is where we get into the point where we are a net exporter of petroleum products, if you will, so far as we're concerned to date, as in 2025, 2026. There's more to the story, and we'll get into that as we kind of go forward. But bear that in mind. So moving forward from, again, 2005 with the reintroduction, because again, this this fracking technology actually goes back to I believe, to the 1930s. It's much more developed, of course, today, but anyhow, interesting points that goes along the way is that, hey, at this point in time, we are a net exporter of oil products, if you will, right? So far as our production is exceeding what we're consuming. So again, it's clear that we're 13.6 million barrels per day. I think we're probably closer to 14 million barrels per day, currently in 2026. So the production has actually gone up a bit. Again, setting aside the whole issue with Iran, the reality is that we're continuing to step up our production, and we are much bigger so far as production is concerned than Russia, Saudi Arabia, Canada. It's absolutely phenomenal how much more that we are actually producing in the U.S. today. So 13.5 million barrels per day, if you will, 13.6 million barrels. So overall petroleum production is actually 22 million. Remember, we are consuming about 20.5, 20.6 million barrels of petroleum per day, and yet we are producing 22 million barrels of petroleum, right? How is it that we get 22 million from 13.5 million barrels that we're pumping out of the ground? Well, it's interesting. So we start with the crude oil of 13.5 million barrels. Plus, we also have what are called natural gas liquids, and that's a huge component, 6.4 million barrels. So that comes from when we're actually producing natural gas. So that would be one of the things that come out of things, as in methane, ethane, etc., right? That are being produced from that when we're processing that natural gas that's taken out of the ground. Because remember, that natural gas can be liquefied. This is the liquefied portion of it. It can also be in gas form, if you will, right? We also have biofuels and oxygenates of 1.3 million barrels. That would include such things, again, as ethanol, corn. I should have said ethanol before, but anyways, that's the corn production that we're adding to the mix, if you will. And there's also what's called the refinery processing gain of about 1 million barrels that's coming out. So nothing changes so far as the content, the weight, if you will, but the volume has increased because it's refined into later products. So it's just the interesting. It's the cracking process. This we could go on for days talking about this, but the takeaway from this is that while we are producing 13.5 million barrels of crude oil per day, we're actually producing or we're producing 22 million barrels a day, based on what I had just mentioned before. And we are consuming some number less than that of about 20.5 million barrels per day. So, interesting world we live in, folks. So with the next couple of graphics, there's a lot going on so far as imports and exports are concerned. Again, the main hub is that, uh, think about it, Houston, Texas, right, right along the Gulf. This is where all the action's going on because this is where uh, crude oil is coming in, um, and it's being refined right there. So, well, we're also exporting a good deal of crude oil, yes. And we're also importing and exporting finished product, so far as gasoline, diesel, so on and so forth, depending upon where we're at when we're with our major trading partners, if you will, um, for this petroleum, and this petroleum industry would be Canada and Mexico. But at any rate, so for example, so what we're what we're doing is that we're exporting again 30 to 45, 40% more petroleum than we're actually importing. All right. So the point again is that the primary exports would be refined petroleum products, gasoline, jet fuel, but also we're exporting crude oil. Netherlands is our number one consumer so far as that crude oil is concerned because, and we'll get into this in a little more detail, but bear in mind that we're looking at basically two different types of oil. One would be a heavy or a sour crude, as it's called, um, or we're looking at the very, very light crude that comes out of from the shale production. Anyhow, a lot of things going on back and forth and so on and so forth. So most of our imports, again, our imported oil is actually coming from where? From Canada. All right. And again, just as a reminder, we are still importing a significant amount of oil per day, 6 to 8 million barrels per day. So with this is just a kind of a quick walkthrough again, this import-export flow chart. So Canada, we're importing again that 57%. This is through pipelines. Coming out primarily out of Alberta, all right, the oil sands in Alberta. Um, Anyhow, we're importing that. That's coming in through our pipelines, and this is that sweet crude that it's highly it's already refined. I shouldn't say refined, but it's very very light crude. And most of our refining capacity is actually geared toward, guess what? Heavy crude. The heavy crude that would be coming from places like Venezuela. Uh, Interestingly enough, right? Other locations as such. So there's a lot of while we're importing from Canada, some of that portion, some of that Canadian crude is actually bound for points such as the Netherlands again, etc. So there's a lot of back and forth that's going on. And of course, we are also exporting petroleum and petroleum products, importing petroleum products. Mexico is interesting in terms of we're importing crude oil and we're also exporting crude oil. So they export the heavy crude to the U.S. I forget the term. They've got heavy crude that they import to the U.S. for our refineries on the coast. So they ship it back and forth across the Gulf of Mexico or Gulf of America, uh, if you will. Anyhow, so there's the heavy crude that's flowing in to the U.S. and that lighter crude coming from shale process is coming out of the U.S. again through the same ports in Mexico. Interesting note. I think I've got. We'll save that for the moment. But so again, there's a lot of back and forth that's going on. Major partner, of course, again, is Canada. So again, we're looking at this is the major refineries, if you will, and this is in barrels per day, and nearly half, or we'll just say 50% of all the refining done in the U.S. is actually done in Texas and Louisiana. Probably some in Mississippi, I guess, too. But anyway, the idea is that it's that Gulf that is centered in the Gulf region there in Texas, Louisiana, and Mississippi as well. So that's a huge, huge portion. What I find most interesting about this, and troubling too, is that the refining capacity is, being focused there. I've I've mentioned this before, but for example, in Michigan, we only have one refinery, and that's the Marathon Refinery in the um, Detroit. I think it's Detroit and Melvindale. Anyhow, it's in the Detroit area, and so we are dependent upon oil from elsewhere. And what's really interesting about it is that if you look on the East Coast, there are zero refineries. Um, so how do they get their product? How do they get their refined product? And this is all done through pipelines, these massive pipelines. So we've got oil flowing in like Keystone and the Keystone XL in the process, flowing down through, and then that's ultimately bound for where? It's either bound for Texas to ship out to Mexico and other points, or eastward for it to be shipped off to the Netherlands. So again, we are the PADD by the PADS. This is Petroleum Defense District, I believe. I forget what the A stands for, but this was set up, I think, in World War II. And the idea again is that when we're looking at where these major refineries are at, they're just again, it's troubling that they're almost all focused along the Gulf. Makes sense in some ways, but it strikes me that there should be uh, more refineries spread out throughout the country. But it's the problem with refineries. I think in total we're looking at. I think I've got it down a little bit later. 130 some total refineries and across the country, and uh, most all of the refining capacity is in this top 20, for example, that we're showing here. And most of those are, again, along the Gulf. And it's dispersed accordingly, through via pipeline, et cetera. So what's interesting about this graphic is that we're looking at, it's not complete, it's not completely, um, it's a very high level, if you will. So we're looking at a lot of crude oil that's flowing through places like, Cushing, Oklahoma. That's a major through point. It's north, south, east, west. Going through Cushing, Oklahoma. Again, where we're seeing pipelines, crude oil pipelines coming down from Canada through Cushing and going south to the refineries in Texas, Louisiana, Mississippi, as I mentioned before. But what's also interesting to note, again, that's the Bakken Formation, again, North Dakota, excuse me, and also coming from Canada through Alberta, et cetera. And there's also coming within Texas itself, from the Permian Basin, West Texas, we'll say. And also there would be New Mexico and Eagle Ford, which is a major, major shale producer along with Bakken and a number of others. Well, you'll notice about the dotted lines, these are refined product pipelines. So this is gasoline being pumped through pipelines. Nothing wrong with that necessarily per se, but again, this is due to, again, that major, massive concentration of refineries, primarily in Texas and Louisiana. The last point here, I've made a note here about the Jones Act. Jones Act is interesting. It's required that if you're transporting um, any goods actually from between U.S. ports. So let's just say, for example, you'd like to ship um, something, crude, in this case, we're talking about petroleum products, right? So we want to ship oil from, um, from Houston, Texas, up to Philadelphia for refining purposes, for example. Then you would have to use a U.S. flagged vessel. Doesn't sound like it's a big problem, but when you're talking about dedicated, uh, it just really restricts the flexibility, if you will, of the industry. This is again, remember, we're talking about overall for the world more than 100 million barrels of oil per day that are being, trying to do what? To be processed, to be refined, and to be shipped out to, the end customers, et cetera. So this is a major, major restriction. When we talk about the Jones Act, I'm not talking about uh, getting rid of it. I was just pointing that out as all. Actually, maybe a couple more points here, but this is something called the refinery mismatch. Basically, the U.S. refineries, and not all the U.S. refineries, but a good portion, especially when we're talking about the ones again along the Gulf, those are geared toward refining heavy crude. There's heavier sour crude again coming from Venezuela, Canada, etc. Um, So this, especially with like Venezuela, that's the heavy, heavy tar oil that would be coming out of Venezuela. But it's not, again, not just Venezuela. The point is that the mismatch is that we're producing, again, shale oil is a very, very light crude or sweet crude, as it's mentioned. So we don't have our refineries are not geared for, it's not to say that they can't switch, but there's a lot involved and it's costly and it's time consuming and so on and so forth. So it's easier to do what? To move that, that crude oil, that heavy crude oil to the U.S. refineries and the light crude oil that's being produced in the U.S. now, coming from shale formations. And it's easier to do what? To ship that, to export that. So it's just kind of an interesting dynamic that's going on. Is that a lot of us? I never realized this before either. There's a much more to this. It's quite an intricate dance that's going on. So anyhow, so far as our production is concerned, again, our refining capacity is that we can we can process about 18 million barrels a day, and that 2 million barrels a day that's going back and forth between the U.S. and Mexico primarily, I believe. That our shortfall there, but the total number of refineries is about 130. But again, most of those are again the top 5 states. They have a close to 70% share of all that refining capacity, and we're looking at Texas and um, in Louisiana, it's much there. Most of that refining capacity is kind of locked up in that area. Again, with Texas at 35% and Louisiana at I got about 16%. So that definitely gets us to that 50%. So there's a lot going on here, and I'll be brief about this. This is the ongoing bit with the Strait of Hormuz. By the time this is published, it might be already solved. No, I doubt that. But anyways, there's much going on, and so remember, there's that 20 million barrel shortfall that's always in jeopardy so far as whether or not the Strait of Hormuz is opened or closed, and at that significant choke point. Near term is that things that could be done over the course of the next year or two. Remember, a year or two. These are long terms this is and I say those are short-term or near-term measures, but because you can't build pipelines overnight, right? So it's just this whole idea is that how do you gain stability? It takes time. How do you address elasticity? Time. There are many things that come into play, but time is a major player in that. Especially well that we've also talked before about the increasing supply that does a great deal too. But again, if there is a time component, this time component is absolutely critical in addressing the issues that we have so far as this um, long-term fix, if you will, toward this issue with the Strait of Hormuz, right? Anyhow, uh, strategic petroleum reserve. This is something where we've got, I forget the number, but it's huge. Billions of barrels of oil that we have that's stored up in places, I think primarily like in Louisiana. I shouldn't say billions. Don't want to say, throw numbers around like that, but there's a significant amount of storage capacity. And this is something that to do what? To stabilize prices. So if there's something that happens, something critical happens, you have something to fall back on. That's a strategic petroleum reserve, which I'm sure is being depleted as we speak. Again, long term is that shift away from being dependent upon the Strait of Hormuz in general. But again, if things could be stabilized so far as the Iranian regime is concerned, so on and so forth, then that will also um, will also have a major impact on going forward. But beyond that, increasing the number of like the pipelines, Saudi Arabia is already talking about, installing these pipelines that, again, these things are not installed overnight or not put together overnight, but being, again, the idea is that you're not going to be so dependent upon that choke point that is the Strait of Hormuz kind of going forward. I think this is something that's been decided. So if nothing else comes of this, is that this is a long-term problem um, that when we're talking about geopolitics, for example, uh, this is a long-term problem that has to be addressed for one, has to be addressed, and this is something that has been festering for at least 47 years, going back to 1979. Okay, so let's see what happens over the course of the next few months and kind of going forward.